Today, folks, things are good. Things are quiet. It's boring across the market. I keep forgetting in the US, you guys are on Thanksgiving. I mean, it seems like every day so far, even on these slow half days in the market, everything just kind of trickles to the upside. There's no more FTX drama. It's so quiet out there. I figured, hey, let's do a bit of a live stream. Let's offer some insight, Q&A, stocks to buy. I want to actually review some of the comments you guys posted and offer some little anecdotes and insights that I think are very fruitful for people looking to edge out a couple extra percent from their gains in their portfolio. We'll talk about some of the index funds, kind of see where they sit, my strategies moving forward here, because obviously I'm not nearly as inclined in this current market environment as it sits today to want to be as aggressive as I was last month. But then we'll talk about some of the growth stocks when I plan on actually entering back into some growth plays, perhaps Tesla, some of the things I'm looking for there. But let's kick it off with some of these Q&As and some of these comments, because these were really good for my video yesterday with Rick saying, how about dollar cost average in so you don't have to worry about all of this? I am buying too high. It's all bullshit. So this guy is talking about the perspective of over, 20, 30 years. You buy the tops, you buy the bottoms, you cost average into these index funds. You're usually pretty good. But I don't like doing that as much, because I really like implementing my capital when I think it's going to offer the best rate of return. Go watch the video yesterday. I kind of show you don't want to be cost averaging at the top of the markets, because you tend to really lose out on some return. So I offered some really simple anecdotes that I just think are really neat, because I don't talk about these very much. But one of them that statistically is apparently true that I started doing about a month or two ago is anytime I buy a stock, I don't buy it at the open anymore, because statistically some guy came out with this rate of return where if you're cost averaging at the end of a day rather than the starting of a trading day, you actually end up with better returns, because typically when the markets are hot, they rally really aggressive in the morning and then slowly fade off into the evening. I've noticed that a lot, actually. And then I've also just kind of pointed out the fact that, you want to increase your cost average investing. You want a strategy for when the market goes down. This is what something a lot of investors that are intelligent talk about. I've seen a few of them where they say, hey, if the market drops 20%, have some extra cash that you never touch as part of your emergency fund. And when the market hits that 20% downside, double up the amount that you're investing. You don't have to throw it all in at once, but just start increasing the amount that you're buying, because that's what's going to really edge out the returns when the market rallies back. Andrew said, my portfolio has finally gone back to break even from deep red. And now you're telling me it's going down again. I agree. There aren't as many deals in the stock market compared to a month ago, but it wouldn't hurt to get another downtrend. So I don't know if the market's going to go down. Every one of the grandmothers thinks the market's going to drop from here. Like literally everyone, all the big crypto guys, they're analysts galore think that we're going to inch out maybe 10% if we're lucky from here over the next year and a bit. I mean, nobody is bullish in this market, yet it doesn't stop the market from continuing to go up, right? So I'm not trying to bet that the market's not going to continue to rally. Let's just take a look at some of the stocks here, and I'm just going to try and show you guys what I'm talking about. And I'm not particularly talking about things like VOO or the S&P 500, because it's still trading down quite a bit off those October lows. I mean, we're up about 12% here, but still down 15.8% on the year for the S&P 500. So I mean, you could easily keep buying this VTI, your global market index fund. Sure, buy whenever you want, but pertainably, I'm looking at more or less trying to inch out the cash flow itself. So I'm looking at these ETFs that I've been trying to buy back into, but I really would prefer to buy them, hopefully not at this kind of petered rally, right? Like, I mean, look at this. The Vanguard VYM here is back up to a recent high for the year. Basically, it's basically flat at this point. And I just don't want to be buying it here. It just feels a little bit out of control. So I'd rather wait than be aggressive at this point, like I was last month, because man, buying these things a month ago was a dream. Like VDY, man, I dumped a lot of money into VDY last month. And just look at this, representing the Canadian economy here. Like, this thing came wickedly off its lows. I think it outperformed the S&P through the month, roughly maybe around the same performance. I'm not sure there. It's about 12.67% from the October lows. And again, now it's green for the year, right? So this isn't where I want to be aggressive. This isn't fun. This isn't entertaining. I like when people are running around like the sky is falling, because, it just seems to be the best, most opportune time to buy, right? So I also want to save up, because at the beginning of the year, I want to max out my tax advantage accounts, my TFSA, RSP. The Canadian government's introducing a new first-time home buyers account, which I think a lot of people don't even realize is happening. But basically, they're going to give you the same perks as an RSP, but specifically for just buying a house. So you can put money in. You don't pay any tax on the money that goes in. It's tax-free when you withdraw it. presuming you're using it to buy a house. And it's only if you're a first-time home buyer, which I haven't bought a house yet. So there's a lot of things I want to take advantage of. And, as the market rallies back, I just don't think it's prudent to be throwing random money in when, I could be getting a lot of tax advantages coming into the early year. Winter is coming to Europe. Might have a hard time going through it. That might very well bring the market down. We'll see. Again, not trying to speculate too much on if the markets are going to come or go. I'm just looking for specific things, right? Like when the market spends a month and a half rallying, probably, again, not the time to be so aggressive, right? But let's talk about some of the individual stocks themselves. A lot of people have been asking me, like, are you ever going to get back into Tesla? What about Meta? Facebook? We'll answer this one here first too. Hey, Kyle, do you keep your REITs outside of your TFSA? Yes. I do that primarily because I want to protect my TFSA as much as possible. The REITs I own don't really grow that much. I think they have some potential in the future, but I don't keep them in there. And I know they're completely tax inefficient sitting in a regular brokerage account, but I mentioned in my videos, you can take that money, contribute it to an RRSP at the end of a year. There's lots of ways you can avoid paying tax. But yeah, I keep most of my monthly paying dividend stocks outside of my TFSA, and I hold no individual stocks currently in my TFSA. But let's just take a look, because a lot of people were asking me about some of these growth stocks recently, like when I'd get back into Tesla. And honestly, Tesla's just been taking a shit kicking, now underperforming GM, Ford, all those companies over the year. I mean, it's down 55% off those highs that it hit toward the second half of 2021. And I'm not going to be buying Tesla. A lot of people are hooked on this stock, and God, there's just something that's been turning me off from it. And it's something that I think should be relatively apparent at this point. And I'll share that with you because it strictly comes from Elon Musk, not the Twitter deal itself, but him just tweeting about, Tesla's updates. And I'll just share this with you real quick because I didn't pertainably like this as much, where he says right in the middle here, Tesla full self-driving beta is now available to anyone in North America who requests it from the car screen, assuming you have bought this option. Congrats to Tesla Autopilot AI team on achieving this major milestone. So firstly, this isn't a real milestone. If you bought full self-driving, you should be entitled to the technology as it evolves. But the reason I will not buy Tesla yet, I want to buy it, I'm just not going to buy it until self-driving is profitable or making money or cash flowing to any extent. Because autopilot works on the highways. They're testing it here in Canada now, not Tesla's systems, but they are testing self-driving vehicles for distribution of food networks. And I don't know how Elon hasn't tapped into something yet where they're just doing it on major highways and where the technology actually works right now. But, he's been promising full self-driving for the last 2.5 years, and it's not here yet. So I don't want to buy Tesla until I'm very confident that that's going to start cash flowing. I'm just trying to hold them accountable at this point, because it's just a car company. It's at this point, it's a technology company, and it's not there yet. It's just kind of a fun toy that you get to pay an extra $20,000 to have a chauffeur, as a technology. It just, I don't know. I don't like that aspect of it yet. It's like, and I can buy a used car and for $10,000 that I could never fill up as much as that Tesla's going to cost still used. Tesla used vehicles, Tesla new vehicles. There's nothing that exciting about the current company, in my opinion, for the value that I'm paying for it. So I need to see something come into fruition beyond just the autos themselves. And I know that's probably hypercritical for a guy that was pretty into it, but I agree. Elon says too much shit all the time. He says a lot of stuff that just hasn't hit a timeline yet where it exists, it's making money, and it's scalable. Right now, it's like we're always on the cusp of self-driving working, but we never quite get there, do we? Just my personal opinion. When are you buying your first house? When are you buying your first house? What accounts will you withdraw from first? If I am buying a house, I'm not going to withdraw from my retirement accounts except for this new first-time home buyers account. But yeah, I'm not in a rush to buy a house. I think buying a house where I live is nuts. I think we've been sold a lie from our parents that you have to have home ownership. I don't think you actually need a house. I think there's nothing wrong with renting, presuming you're saving money and you're getting cash flow and passive income from other assets. But when you live in the world where I live, where the average house is over $1 million, and I don't live in a nice neighborhood, it's kind of nuts to think that, putting yourself, coming up with $200,000 or $300,000 down on $1 million property to be $800,000 in debt is a good thing. And people act like it's normal. They're like, oh, I make 6 figures, I'm going to go buy $1 million home. And like, okay, put yourself $500,000 plus in debt. All the power to you. I'll probably go buy a house if I end up buying one somewhere outside of Ontario, specifically maybe Alberta. I don't know. I'm not there yet. I have so much cash, man. Like I got, between me and my fiance, like we're good and we don't have to worry about shit. If I buy a house now, I have to worry about shit. I got to get insurance. I got to deal with a mortgage. I got to liquidate half my assets. It's like, Ugh. Meanwhile, you come up with $800,000, you make enough cash flow off of that to basically pay your rent for the rest of your life. And hey, yeah, rent goes up over time, but so do dividend payments. Plus we're mostly rental locked too, right? So obviously I'm renting. And when I mean renting, I am still living between my parents and my girlfriend's place, because unfortunately this year wrecked me and my parents in more ways than I can talk about on the stream. So yeah, I planned on moving actually a while ago until this whole economy collapsed and screwed up my parents. Put a hiccup, I won't say fully screwed up, but put a hiccup and a dent in my parents' retirement that I've been helping them get through. So once I get through that and a few other things, hopefully early next year, I can get out of Ontario and move down to Alberta. Yeah, but if you're living in the same location pretty much permanently, why wouldn't you buy? See, I'm not. That's the thing. I'm not permanent. I'm not permanent. I don't have kids. I'm not tied directly to my family. I'm ready to go, man. I'm like, I don't care where I go, wherever's affordable, wherever's cheap, and whatever's comfortable for my girlfriend / fiance. Yes, live with your parents as long as you can. Keep stack. Yeah. See, this is the thing, right? Like, I'm not for living at home. I'm not enjoying it. I'm barely at home. Like I said, I'm all over the place right now. But if you're a younger person, you don't have a choice. If you live where I live, you're not buying $1 million house coming out of school being in debt, or even just coming out of school with no money. You're 25, 26, a degree, you paid off the degree. You're still broke and you're going to be saving for the next 10 years to buy a house. I'm sorry. Buying a house in Ontario, leave. Just leave. If you're a millennial, if you're like 20, go explore, travel, get the hell out of Ontario. You'll be broke here forever if you buy a house. I'm sorry. Buying $1 million home and thinking it's normal, making 50, 100K a year is nuts. It's not a lifestyle you're going to want. It's your standard of living is going to go in the toilet. I promise you. You'll be working too long, no time for the wife, the family. You'll be broke forever. Enjoy working yourself into the ground until you're 50 or 60. It's dumb. If you're traveling around a lot for your career, then go ahead and keep renting. But if you're staying, yeah, I agree. If you're staying somewhere, but only if you can afford to stay there and make sense of the financing. Because the math doesn't make sense where I am unless you're making $150,000 a year. And I highly doubt most of you watching this are making $150,000 a year. So, get out of this stupid country, go live somewhere that's comfortable where a house costs maybe $500,000 or less. You don't need to buy $1 million house, though. What's wrong with a condo? A condo costs $800,000. The average condo in Ontario is $780,000. It's nuts. And you're going to pay for what? 800 square feet, maybe, if you're lucky. You really want to live in a condensed little box with maybe a 1.5 bed for almost $1 million. It's like, come on, man, you got to leave. You go to Barrie, you can go up north, cottage country. You're kind of getting me down this rabbit hole of real estate. I argue with my parents. The generation before us, these boomers, they seem to think that this is such a normal thing, that real estate just keeps going up. Just put yourself, hundreds of thousands of dollars in debt. It's just dumb. Like I said, I'm completely free right now. I have no liabilities. I owe nobody anything. Cash flow like a crazy man, and there's no complaints. I'm a millennial and bought a condo in Toronto, and I'm doing just fine. Thanks, not broke. If you live in Toronto, I'm presuming you make a lot of money, and it also presumes when you bought that house, right? Because you bought that condo 5 years ago, it would have been reasonable. You could have bought it for under $500,000. You're buying a condo today in Toronto, you paying $1 million, or at least damn near close to it. And you ain't doing that without making, $150,000 to $200,000 a year. So, again, how much debt are you in versus equity you own? My rule of thumb with real estate specifically is that I don't want to be any more than half in debt with my assets, right? So it's like if I'm buying, say, a $500,000 house, I need to know that, basically, so let's presume you put $100,000 down. You're going to be $400,000 in debt. I better have $400,000 in assets outside of that debt backing it. So at least I'm at parity. I will never be more. I don't want to owe more than I have in savings. It's as simple as that. It's not. It's kind of a hard formula because it's impossible when real estate's so expensive. But hey, I just don't want to do it. If a house cost me $1 million, I better put $500,000 down and still have $500,000 in stocks because, I don't want a $500,000 mortgage and nothing backing it. Pay off $1,500, call them 1.99% contribute. I'm kind of going down a tangent here. We're supposed to be talking about stocks. You guys got me on real estate, damn it. The damn real estate rabbit hole that's plaguing millennials and any generation before to like. You guys are something else. Average price for a 3-bed, 2-bath here is $550,000 and 50 north of LA, California. No traffic here compared to Los Angeles. See, that's probably it's still kind of pricey, but not bad. For LA, California area, I guess. I know that's pricey areas though, but there is good debt and bad debt, bro. Not all debt is bad debt. All debt is bad debt, my man. All debt is bad debt. Don't go down that rabbit hole. You're getting conned. You want to know what a con feels like when the market crashes or interest rates go up. If you locked in a 20 or 30-year mortgage and you're strict on paying it off, then good for you. But a lot of people have variable rate mortgages right now, and they're starting to realize that that debt wasn't as reliable as they thought it was now that they're paying an extra $100 a week. I literally know people paying more than $100 a week. All debt is bad debt. I'm sorry. The bank can suck my, they can suck me off here. I'm not dealing with the bank. I am the bank. The bank needs me. I don't need the bank. I'm not going to go down the margin rabbit hole. Put yourself thousands again. There is no good debt. There's reasonable debt and there's terrible debt. And you can say real estate's good debt, but it's not if you're over $500,000 in the hole on your real estate and you don't have any other assets. And you're like, oh, my house is my asset. It's like, well, you're heavily over leveraged. It's very risky stuff. Again, I don't need to, like I said, I don't want to get too heated up here. Los Angeles is like 800,000 in shithood. We live in a nice neighborhood. Yeah. I mean, that's the same thing with Toronto. So I'm glad you're kind of moving out of the city, waking up to the reality. You don't need to be, that's what I thought, right? Like you have to be in Toronto to make it. You don't have to be in Toronto to make it. Toronto it's a mess. It's a concentrated shithole of wealth chasing. LA is roughly the same. It's all clout chasing. Like I was talking to some guy about this, that like, I feel like when you live in these areas of extremely expensive, like there's this crazy divide between the rich and the poor that starts to happen. There's a disparity you start noticing in theft, homelessness. You're seeing it in San Francisco. You're seeing it in Los Angeles. It's really, really bad. And then you get all this clout and money chasing kind of attitude. Like unless you're making 152 $250,000 a year, you're basically broke living in those areas. Like there's no point living there. So you're just kind of chasing this ego thing to try and make it, but you're not making it. You're living a low-end lifestyle on a $250,000 salary because your rent is $4,000 or $5,000 a month. Your mortgage is $4,000 or $5,000. Like you're literally living a middle class or lower middle class lifestyle as a millionaire in one of these cities today. There's no point living there. You want to be a millionaire? Go make a high-end salary and go live somewhere where properties don't cost $1 million. Then you'll feel like you have $1 million. Because your $1 million house that you want to buy is like 5-10 bedrooms, 5,000 square feet, not in these major cities. So don't trick yourself into thinking that's the lifestyle that you think is going to, that you have to live up to. It's kind of jammed into us that's you have to make it somewhere. It's like if you're not in New York, you can't make it here. You can't make it anywhere. It's like, no, you can make it anywhere. We have the internet today. I make 6 figures from any bedroom anywhere I am. It's like I could go to Thailand if I want. I don't need to be here listening to your bullshit and paying these high prices. There are also more job opportunities than random little towns or whatever. Yeah, I would agree that the big job opportunities are in the big cities 100%. But the question is that the lifestyle you want to live, and do you want to work that hard to have no money? Because like I said, I know a lot of people worth millions of dollars in the city. Their house isn't any bigger than some guys somewhere else, yet, they're millionaires, but they look like they're middle class. They don't look like millionaires in the city. Nobody that's a millionaire in the city is a millionaire. I don't know. Like I said, I'm not trying to harp on Toronto. I've been here my entire life. It's just that you step back 5 years in time, and I'd have no problem buying a house here because 5 years ago, it wasn't what it is today. Real estate's basically doubled. I read 8 billion liabilities and less than 500 million assets with the FTX Ponzi scheme. FTX is done, my friends. Crypto is not the time to be buying just yet. There'll be a time to get back into crypto, but it's not right now. AQN crashed heavily lately, down $10. Yeah, man, it hurt me a lot here. A bit of a gamble, but I'm loading up on them now. I would definitely read into it. I do think they're trading at a more of a discount now because of their lack of ability with their. Comes back to the whole point of good debt and bad debt. Algonquin Power is a utility. Utilities are heavily indebted. They're very similar to telecom and real estate. They use debt to build up the infrastructure. Usually municipalities and governments back the infrastructure because obviously it's municipal regulated. You're keeping your lights and your hydro on. The problem is Algonquin Power decided to use variable rate debt. They had probably, floating lines of credit. They were using, like locked in debt. They should have had like 5-10-year mortgage rates or lease rates on their debt. Which is really annoying to me because they're just getting slaughtered by the way they manage that debt. Whereas you look at something like a Fortis that's been doing great. I looked at a lot of utilities that are doing just fine. Same with REITs, right? Like REITs have usually 3-5 years locked in on their current backdated mortgages, properties. So they have somewhat stability to kind of ride through this interest raising environment. Whereas unfortunately Algonquin Power didn't. So we ended up selling our Algonquin for a loss. My family, I looked at it and I just don't want to deal with it right now. So I'm trying to stick to the more solidified companies that I know have done a good job through this crash than try and buy something like Algonquin that, though may be cheap, has to fight now to kind of get their cash flows back up and remanage their debt. What else we got going on? Read the book, Millionaire Next Door. Millionaires often don't look like what you think one should look like. I do agree with that. If you saw me walking on the street, I look like a bum. I know a lot of millionaires that look like bum. I'm not a millionaire, but I figure most of them are just bumming around like I am. Maybe putting a suit on only from the waist up because I'm not wearing a suit below this camera. So, Kyle, what are your thoughts on CNR and ATD? CNR, I think you're talking about Canadian National Railways, pretty good. I don't own it, but I think Buffett, I don't know if Buffett even still owns it, but obviously it's kind of an undisruptible business. Alameda Couche-Tard, that's another one, guys. What a weird name, French name for a company. Actually, these were rated from some analysts as like the best buying stocks in Canada right now, I think. This is like the max milk. Look at the stability in this chart, man. This company's done one hell of a job managing these little convenience stores. And it's still trading at a reasonable valuation too, which is what's kind of crazy about this one. These are Canadian stocks, man. Honestly, I think I'd rather buy Canadian stocks right now than US stocks. I think the US is still relatively overvalued. It's really hard to wrap your head around if we're coming or going. Whereas in Canada, our stock exchange has always been kind of at a really good fair value because we're primarily financials, banks. The banks are really cheap right now. Energy is still reasonably valued. It's not crazy expensive like it is with, I think Exxon's pretty expensive in the States. They've all kind of come back aggressively. Whereas, Enbridge, which ironically, Enbridge has shut down not the Gardner, but below the Gardner in Toronto because they're replacing a high pressure line. But even this thing, I'd still think is reasonable at this price. I don't mind Enbridge here. But yeah, Enbridge is funny because I just saw that on the news today that they're making gridlock in downtown Toronto because they're fixing their lines. Couche-Tard is a 24 convenience store, and Couche-Tard means going to bed late. Funny, nice name if you ask me. It's a French company, isn't it? I do believe it comes out of Quebec or something like that. Your thoughts about Algonquin Power? I just said that I'm not buying it. I sold it at a loss. Me and my family exited that one just because I'd rather own Fortis or something that has a larger market cap, better debt management, blah, 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 blah. Life goes on. From a growth perspective, though, outside of that, guys, let's just take a look at the sticks across the board here. See how we ended this shorter day on Friday for the U.S. investors out there. It's weird you guys are having your Thanksgiving. Why can't our Thanksgivings coincide between Canada and the U.S.? It'd be really nice. It'd make things easier because I had a lot of people not show up to meetings yesterday because they were all from the U.S. and I forgot that it was Thanksgiving. But taking a look, guys, it looks like we're heading into the close at flat. Mostly, I mean, VFE, the Canadian indexes, VOO, all just kind of flat today. Again, boring, right? Super boring. Crypto's been holding around 16,500 for Bitcoin. My REITs have been doing very well. RioCan, Smart Center's coming back. Enbridge, all these Canadian stocks kind of just holding flat here. There's really just not much going on, man. There's no more, like, this last week has been quiet after the FTX stuff. Volatility's calmed down a bit. People, I think, are a little more optimistic, even though the data's not all that optimistic. I mean, a lot of debt going on. Not sure what that means for the economy, but thoughts on COSM and getting like 10x volume over the last few days. Let's just take a quick look. We can do a few shout outs here and just see what you guys are talking about, because this is, stocks to buy. So COSM, is that the stock? COSM, what's this one? Cosmos Holdings, one that I've never heard of before in my life, and already I'm really not turned on by it with the 88% loss this year and the 5-year chart looking even worse and the max chart looking even worse. I don't know what this is, but it looks like you be playing the penny stocks, my man. I'm very careful with the penny stocks. It's nice to see that it's jumping up 500%, but that's what penny stocks do. So just be careful with these ones, man. These low float, high volatility stocks are crazy. Is it still okay to buy VDY? Yeah, I am still buying these stocks. I am cost averaging into them. I mean, I've got $140,000 sitting in VDY, and I do have it set up on a drip. So even though I'm not putting working capital into it, I'm saving cash. I am still buying this probably more aggressively than most people are, because I mean, it's 4% dividend yield. I mean, between the money I have in there is what, 5,000 or 6,000 I'm getting off this one stock, like $450, $500 a month, literally just on a drip. Which is super awesome. So yeah, I'll be buying it here. I think it's reasonably valued. The stocks in it are amazing. We just have to get through bank earnings. So one of two things is going to happen in the next week or two is that Royal Bank, Bank of Nova Scotia, Canadian Imperial Bank, all the banks are going to be posting at the end of this month, and 50% of VDY is exposed to the banks. So if Royal Bank, Toronto Dominion Bank, if they miss or something happens, this ETF's going down with them, because 23% or something of this entire ETF is just in Royal Bank and Toronto Dominion Bank. So do keep that in mind. Usually I don't like buying stocks around earnings, but if you don't own this, you're cost averaging into it, maybe just save a bit of money on the side just in case it dips after earnings. But who knows? Maybe the earnings come out good and it rallies. I just have a hard time believing we're going to see a wicked rally out of these bank earnings. But then again, JP Morgan did. I mean, after the JP Morgan earnings, but then again, JP Morgan tanked, right? So, JP Morgan dropped so hard that the earnings weren't nearly as bad as people anticipated, and it rallied back like 31%. Whereas Royal Bank right now isn't crashed at all. The Canadian banks are so damn resilient this year. It's only down 1.48%. So I don't think we can get an earnings rally beyond what we've just experienced here. So this is why I'm hesitant on buying stocks at the current moment. I'd rather just be a little more patient. But yeah, just my opinions. The general counsel, the current CEO of Alameda Research, is the daughter SEC. Oh my God, you guys and your FTX here. I trimmed 10% of VYM and SCHD holdings after the recent rally to cash up a bit, because I do want to have some dry powder if it goes down to 10 or 20% in 2023. Yeah, there's nothing wrong with that. I am still wanting to buy VYM and SCHD. I'm just cost averaging with the dividends, but I'll wait until I can contribute to my tax advantaged accounts. And then I might just see if they roll off from the current rally. Because again, this 1 month rally has been very nice, but I just have a hard time trusting it. Don't use that as financial advice. But on that note, folks, I think we've had a bit of an exploratory video today, an exploratory video, just kind of going down the rabbit hole. I really appreciate everyone showing up. So stay cool, stay awesome, enjoy your weekend, and maybe we'll start doing some more of these live streams more often. Maybe we'll do a 1 week live stream, every week. But stay cool, stay awesome, folks, and I'll catch you in the next one.